More money printing by the Federal Reserve may be a waste of time. That, according to Neal Lipschutz, who's coming on the set now to explain himself. Right. The Fed is watching right now because they're hanging on your every word.
There you go.
Waste of time. They're my words, but I think it expresses what you feel.
Your words, yes. And it's not, listen, it's not an original thought. There have been various commentators out there. But listen, what is the whole point of further easing? The whole point of further easing is to get interest rates lower. Interest rates, for all sorts of ominous reasons out in the world, are extraordinarily low. We have a 10-year note that was around 1.5%. We've got a federal funds rate that's at 0. We've got mortgages below 4%. So what more can the Fed do? Nothing. So it doesn't make sense to take the risks of another quantitative easing if the end result of that easing has already been achieved by the market.
What are the risks to me and you of more money printing? And let's call it money printing because I think that people understand that better than the
well, that they essentially would go out. Let's say if they did another traditional round of quantitative easing, they would go out and they would buy more securities. Therefore, they'd be putting more demand into the market for treasury securities, perhaps for mortgage-type securities, and therefore interest rates would come down because there's more demand. So the risks are their portfolio keeps getting larger and larger, which at some point is going to be a problem to resolve, and to how do you exit from that if and when we get to more normal times. But there are other issues as well. In other words, you know, there's this notion that some people have that I think makes sense as well, that, you know, at some point we've got to not depend on the Fed all the time to try to either you know, perhaps goose equities to some degree as interest rates come down through this, or even spur the economy further. And others have made the point, which I agree with, is that, you know, it's not so much the interest rate level that's keeping business from expanding and hiring. It's all the uncertainty. It's the issues in Europe.
Is that policy uncertainty partly caused by the Fed and not knowing what it's going to do? I mean, because people talk about policy uncertainty, don't they?
Right. I don't think it's so much the Fed. In my view, is more not that the Fed's caused uncertainty, but the Fed's done its bit. You know, the Fed really can't effectively do much more, and now it's up to, you know, the fiscal authorities, who of course have been fractured in the United States and divided, to come up with some reasonable long-range, not short-range, but long-range plan to bring in deficits, to bring down spending to some degree, and to regularize regulatory regimes. And that's, you know, again, no magic wand. I mean, we're still, you know, in trouble because of the European problems and because of the slower growth in China, et cetera. But that at least would take away the kind of uncertainty for the people who make the decisions that eventually result in more jobs.
No, I tend to agree with you on the no more money printing, please. I think we've had enough. It really hasn't, you know, if it's done what it can do.
That's right.
What about this as a radical idea? And you didn't write about this, but I'll throw it to you anyway because you're a smart guy. What about increasing short-term interest rates? Because that would give people with cash balances income, like pensioners, people like that who've got large cash balances. They would get more income, maybe take it up to 2%. Maybe people would get the income in, and then they might start spending that. And tax revenues from that would go up. What do you think?
I mean, it's a radical notion.
I admit it's radical. I throw it out there.
I don't think it will happen because, frankly, I think the Fed chairman has been asked those kinds of questions because one of the, you know, we've been in emergency zero short-term rate policy now since, you know, for many years.
It's killing my savings. And not that I've got much, but it's killing them.
But all sorts of people who are savers have been penalized, and I think the view is that that is an unfortunate consequence, but getting the economy going is a bigger issue, and therefore those people will be helped when you get up there. So I don't think it's going to get there, but it is a notion that, you know, the point I think that you're making that I do agree with is that I don't think at a 1% or a 1.5% short-term interest rate, the level of borrowing and demand for capital to expand and to hire would be very different than at zero federal funds rate.